As 2023 wraps up, we're on the brink of 2024, a year that's shaping up to be promising for both dividend and income investors. This surge of optimism stems from a key announcement by the Federal Reserve on December 13th. In their final meeting of the year, the Fed members shared their plans to cut interest rates 3 times in 2024. This revelation has sparked enthusiasm in the stock market, with noticeable rises following the announcement. But there's more good news. Certain investments, especially those known for hefty dividends, are predicted to enjoy greater share price increases this year. These sectors, which have been lagging in recovery while the overall market thrived last year, are now in the spotlight. In this video, I'm going to explore potential investment opportunities in 2024, focusing on particular sectors, companies, and funds that seem poised for growth. While some investments appear more promising than others, and a few have struggled in the past year, investments typically flourish when interest rates are cut or remain low. With the Fed likely to lower rates, sectors that frequently borrow substantial funds, either for expansion or maintaining costly assets, are expected to benefit greatly. The infrastructure sector is one of the first to potentially reap greater benefits in the evolving financial landscape, particularly those that often offer appealing dividends. This sector encompasses both dedicated infrastructure funds and companies whose core operations rely heavily on extensive infrastructure assets. Such assets include railways, bridges, and facilities vital for freight transportation. These companies typically need to secure substantial loans for the maintenance and enhancement of their primary assets. High interest rates can significantly increase their borrowing costs, leading to a domino effect of adverse outcomes. Not only does this escalate the interest expense, reducing net income, but it may also force management to delay or cancel plans for expansions or asset upgrades, which could otherwise open new avenues for business. The situation is even more challenging if a company needs to refinance significant debt under high interest conditions. However, with a shift towards lower interest rates, these companies could find themselves in a position to borrow more affordably, enabling them to expand and improve their infrastructure at a reduced cost. While the investment options in infrastructure that also pay dividends are somewhat limited, there are still a few noteworthy choices in this niche, offering investors an opportunity to tap into this potentially lucrative sector. For investors interested in infrastructure assets that also offer dividends, Brookfield Infrastructure Partners, with the ticker symbol BIP, is a master limited partnership, MLP, to consider. This partnership manages a range of infrastructure assets and has been showing signs of recovery, particularly with the anticipated fall in interest rates. One aspect to note about BIP is that it issued a K-1 tax form, but it's being recognized for its consistent dividend growth over time. Another viable choice, which doesn't involve dealing with a K-1 tax form, is the Cohen and Steers Infrastructure Fund, known by its ticker symbol UTF. This close-end fund primarily invests in value stocks of infrastructure companies across various market capitalizations. UTF is an attractive option for those seeking higher yields, as it pays monthly dividends. However, unlike BEP, which has a record of increasing its dividends annually, UTF hasn't shown the same growth in its dividend distributions. This difference is an important consideration for investors looking for steady dividend growth in addition to yield. The utility sector is another area expected to experience growth in 2024. These companies, which include energy corporations using natural gas pipelines, cell towers for telecommunications, and various green energy stocks, often require substantial capital to develop and maintain their assets, such as pipelines, cell towers, electrical grids, and wind turbines. However, a unique challenge for these companies is the direct link between their performance and the market value of the commodities they utilize or produce. For instance, the success of natural gas companies is heavily influenced by natural gas prices. Even if interest rates are lowered, making it more affordable to finance and expand pipelines, a decline in natural gas prices could still adversely affect these companies. This principle applies across the board, whether it's cell towers or other utilities. If the value of their primary assets decrease, lower interest rates won't necessarily compensate for the loss. In the realm of natural gas, Enbridge stands out as a strong contender. The company has been successful in expanding its operations, maintaining robust free cash flow, and consistently increasing its dividend distributions. While the future prices of natural gas in 2024 are uncertain, Enbridge has a history of performing well in various market conditions. For those looking for alternatives in this sector, Energy Transfer, ticker symbol ET, and Enterprise Product Partners, ticker symbol EPD, are worth considering. Additionally, the Reeves Utility Income Trust, ticker symbol UTG, is a monthly paying closed-end fund that invests in various utility companies. However, it's important to note that this fund has recently shown signs of struggling to increase its dividend, currently going through its longest period without a raise, despite a previously strong record of dividend growth. This is a critical factor for investors focusing on consistent dividend growth. The REIT, Real Estate Investment Trust, sector remains undervalued, even after modest gains in 2023. These entities often need substantial financing to acquire new properties or upgrade existing ones. REIT dividend aristocrats like National Retail Properties, ticker NNN, Federal Realty Trust, ticker FRT, Essex Property Trust, ESS, and Realty Income, ticker O, are all currently trading at discounts. A notable subsector within REITs is those that also hold utility assets, such as cell towers. Companies like Crown Castle and American Tower have been trading at significant discounts. Despite some recovery in 2023, they are still far from their historical average valuations. For those seeking high-risk, high-reward opportunities, office REITs are extremely undervalued. There have been ongoing discussions about a potential collapse in commercial real estate since 2020. While some office REITs like SL Green Realty have cut their dividends, they represent a potentially lucrative opportunity for risk-tolerant investors. However, personally, I'm not investing in office REITs, nor am I optimistic about mortgage REITs, which haven't performed well even with low interest rates. In terms of high-yield corporate debt, several PIMCO funds, PDI, PCM, PTY, have seen their NAVs drop with rising interest rates. Yet, a cut in rates could boost these bonds' value. There's a critical moment for PIMCO funds now, as dividend coverage has been weaker this year, raising questions about potential dividend cuts in their popular funds like PDI. Another high-value bond fund, Guggenheim Strategic Opportunities Fund, ticker GOF, has struggled but hasn't cut its dividends yet. In my portfolio, I'm also focusing on business development companies, BDCs. While many BDCs are now trading at pre-pandemic levels, some are still undervalued. However, their high payout ratios or decreased NAVs might deter investors. My strategy will be less aggressive compared to 2023. Additionally, with interest rates cut, stocks in banking and finance, like those held by SCHD, could see improved performance. Going into next year, I'm considering whether to unload some positions, especially as the market has been soaring, including stocks I might sell. I'm delaying any portfolio changes until I see how the early part of the year unfolds. For those interested in following my investment journey, including updates on my holdings and discussions about high-yield investments, feel free to check out my other videos. And for more content on high-yielding investing strategies, don't forget to subscribe and like this video. Thanks for watching, and take care until next time.